They are destroying the dollar. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the dollar is rapidly losing value as the Fed seeks to undermine its status as a global reserve currency. And this is a story we're hearing more and more out of the mainstream media as we're starting to watch the dollar decline in value, for which many people believe is the beginning of its inevitable plummet down to zero. And people are also now blaming the Federal Reserve and its monetary policies for having such a negative effect on the currency, which will ultimately lead to its status as a global reserve being revoked. And in today's show, we're going to take a look at what's really going on with the dollar, what the Fed's intended effects were to be, and why what you're seeing right now in the dollar with the decline in relative picture to the global economy suggests that something far worse is going to happen than just a matter of it eventually losing its reserve status. Let's over to Bloomberg, where we picked today's story up with a headline: U.S. core CPI jumps again while showing some hints of moderating. And if we have to start the story out with, of course, the consumer price index, because what I want you to understand is what's going on with the Fed and consumer prices isn't just a matter of people paying more than they did a year ago, which of course is what the consumer price index indicates. When we put this in relative picture to the dollar, what I want you to start looking at the consumer price index is a barometer of demand. So when you have a point where demand is greater than supply, what we should see, of course, is a consumer price index increasing. But if you have a setup now where demand is falling despite the fact the supply is tight, well, you have a bigger problem. And then when you link that to the dollar, well, as you'll see by the end of the show, something much worse is coming. The core consumer price index, which excludes food and energy and is closely watched by the Fed, rose 0.4% from the prior month, following a 0.5% gain. And yet, key measure of housing costs, which we've mentioned in prior shows and we'll talk about again, posted the smallest monthly increases in about a year ago, and grocery prices dropped. So this is key because the core inflation excludes food and energy. They're very volatile, but the big issue underneath this report is that housing is fairly sticky. And the problem with shelter inflation, it's somewhat made up. The Fed does not, or not the Fed, but the Bureau of Labor Statistics doesn't have a good metric to measure it. So they sort of fudge the data every month. And when that starts to tip and fall, well, then watch out. This index is going to come down in a big way. In fact, the trend is already slowing, as we suggested in yesterday's show. But let's look into this report a little bit and see what we can find, because what we can note that all items less food and energy rose at 5.6%, which is slightly higher than last month. But look at this, the headline dropped to 5%, which is now showing that inflation, as we predicted, would slow down. And notably, look what's happening. Energy down 17% year over year. So that is huge, with only electricity showing now double-digit gains. But as we get down into the core, there's something I want you to know. It's not only is used cars coming down, but transportation services remain high. But here's the other one, shelter. But broadly speaking, what we're seeing is these numbers start to fall. And what this is starting to suggest is demand is cooling off here. And when you put that, again, as we look at what the relationship between demand and the dollar, well, that's where you start to get to the picture that something is seriously wrong in the global economy. And here we can see shelter and rent inflation on a year-over-year rate of change, and this remains very high, in fact, unusually high historically. At some point, and maybe it's next month or in the next couple of months, this too should roll over and head down, because it's one of the most lagging internal components to the consumer price index, and so it's kind of keeping the index elevated right now. But once it starts to fall, well, there's a reason it's going to drive the headline number way down. And that's because shelter costs, which are the biggest services component and make up about a third of the overall CPI index, climbed 0.6%. Housing cost measures advanced at the slowest pace in about a year, while hotel prices jumped by the most since October. And because of the way the housing metrics are calculated, and this is kind of what I suggested here moments ago, there's a significant lag between the real-time price changes and the government statistics. Other metrics suggest these gauges will soon turn over, but economists economists are split on the exact timing because, again, no one's for sure how the timing of this thing is going to work. But what we do know, because it's the biggest piece of the services component of the CPI, that when it turns lower, we're going to see a rather dramatic drop in the index, which could push it rapidly down to the Fed's 2% target at a time when they're extremely tight in terms of how far they've raised interest rates and how much they're unwinding the balance sheet. And of course, all this should be having an impact on the dollar, but it's having actually the opposite impact. But as we talk about inflation, we mentioned this in yesterday's show when we were talking about the declines in the money supply. So if you missed that, be sure to tune in after you watch the show. And what do we note? The consumer price index is largely a function of energy prices. So it's no surprise this should come down, particularly the headline CPI number. Now, I know the core is remaining rather elevated, but as we noted, that's highly concentrated in the services sector. So here from this chart from Zero Hedge, we see the U.S. CPI urban consumer services less energy services in green, and you notice it's rather elevated here as, of course, consumer commodities less food and energy year over year is relatively down. So what this tells us is that this housing metric is artificially keeping up the data point here, because the services sector, if we kind of go outside of the housing market, well, is there a lot of demand in the services sector? Well, not so much. And we covered this recently when we talked about the ISM services PMI here from the headline. It's down to 51.2, as you may recall. And so what this is suggesting is, broadly speaking, the service sector is expanding now at a snail's pace. So the idea that we're going to continue to see services inflation, well, that's not going to come out of the actual services sector as much as it's coming out of the shelter component of the CPI. Then the latest jobs report didn't help either, showed the pace of earnings growth has slowed in recent months to a rate more consistent with the central bank's 2% target, something we've been making the case for on the show for a while that is inevitably going to happen. And that said, economists will be closely watching the employment cost index, which is viewed as a cleaner, more accurate measure of pay growth, coming later this month. But today, here's the big one. A separate report out Wednesday showed real inflation adjusted average hourly earnings rose a mere 0.2% in March, the first increase this year, and we're down 0.7% from a year ago. But here's the challenge, and as many of you have said in the comments, look, Steve, it doesn't matter. If inflation comes down, my pay is not going up that much. It's still not keeping pace with inflation. In fact, it may actually be worse than that, as this next chart now shows, again, why we're seeing inflation coming down. Again, we're going to tie this all back to the dollar in a little bit, but what I want you to understand is the demand component from this economy is slowing down. It's not a U.S. issue, it's a national issue that's happening here. And when you start to see this as a point where demand is declining at a point when supply is believed to be rather low, you've got serious underlying problems in your economy. And this chart here shows the consumer price index in blue against average weekly hours of production and non-supervisory employees. We're focusing on the manufacturing sector because these tend to be more of the higher paying jobs. We don't want to mix in a lot of the lower paying part-time services job. But notably what we see here is on a year-over-year rate of change, and these are on the same side of the chart. What do we see on a year-over-year rate of change? That average weekly hours of production and manufacturing sector are heading down. So we already know their wages aren't keeping up. But look at this, as hours of production decline, what eventually follows is a sharp drop off of inflation. So what we're seeing is hours decline, wages decline, demand decline, and that means the CPI is coming down. And now let's zoom back into that real average weekly earnings. This chart, again, provided by Zero Hedge, notes that about 24, I believe, consecutive months that inflation-adjusted earnings have been negative and on a year-over-year rate of change. So what we're seeing here is two components that are causing problems. One, wages aren't keeping up with inflation, which means there's less demand in terms of consumption that's being backed up by hours worked, and all that translates is to inflation coming down. But it's not just inflation that's the issue here, it's the underlying problems with the global economy and the U.S. economy. So now let's look at this from the dollar's perspective. And here we can see in this chart on the dollar that the DXY is trading around 101. And we're not going to get into the details of trading the dollar here, but I just wanted you to see from a big picture what's going on. And this decline in the dollar from peak of 114 down to the current level is kind of being cited now as, hey, this is the end. This is the beginning of what will be a long decline in the dollar. Eventually the world's going to wake up and ditch it as the global reserve currency. And what we're seeing in this chart, though, is the dollar has just been weakening, and if it breaks through the support level, likely to go down to 98. But one of the issues we face here is that is not the intended effect of what the Federal Reserve wants. See, many people believe just the opposite is true, including the Fed, that when the Fed tightens monetary policy, that somehow they're destroying dollars. But guess what? The Fed doesn't have any power to create money, any more power than they do to destroy money. But the whole idea, and we've talked about this on the show before and even featured articles where the media suggests that as the Fed tightens, the dollar goes up in value. Well, now let's put that to the test as we've done before. And what do we see? That there are periods indeed where the dollar is declining in value, as we see the nominal broad US dollar index in blue against the federal funds rate. Here you can see going into the global financial crisis, the funds rate was declining, and that should mean the dollar should increase in value at some level here, and it did eventually. But notably, if we're seeing the opposite effects, if we're seeing the Fed tighten policy as we did here and the dollar decline in value, here we see the Fed tightening, the dollar starting to decline in value, there is indeed something wrong here. And that is the ultimate question. So now let's put this in component of the CPI, where we started the show out, as we get to the ultimate answer here. And that is when we put it in comparison with the consumer price index, what I want you to see is, here you see going into the global financial crisis, the dollar was decreasing in value and we had an increase of inflation. Sounds somewhat familiar? Well, it should. And then what happened? Inflation came crashing down. And notably, we're seeing that now. We saw a rise in the dollar first, now followed by a decline in the dollar, but inflation too is also coming down. And so the way I want you to put this in perspective is the dollar, of course, is a global reserve currency. When you see demand in the global economy, when the global economy is growing, expanding, and doing great things, what should we see in the dollar? It should go up in value. People should be demanding it. So when you see the dollar weakening in value, it's not telling you the global reserve currency is going away. It's not telling you the Fed's actively trying to undermine it, because they actually want the dollar to be stronger. Because if you have a strong dollar, you kind of get rid of inflation. So what you're seeing is demand from the global economy is falling. And when you start to pair that with the consumer price data from today, what you're seeing from the US consumer is, hey, not only is demand falling, but we can't afford it anyways, because our wages, our inflation-adjusted wages, are negative and have been negative, and that's translating to fewer hours work, and that's translating eventually into higher unemployment claims. And now we can look at the crude oil market and see that, again, more validation that demand is coming down. We see crude oil inventories up almost 600,000 barrels, distilled stocks down about 600,000, gasoline down a little over 300,000. And you say, well, that's not that big of a change. But remember, these are big holiday weeks, and I happen to live in the vacation destination of the world. I can tell you activity here is fairly busy, but if there was a lot of demand over these weeks, we should be seeing huge declines in energy, but instead we're not. And how does that translate now to the dollar and energy? Well, here we can see crude oil prices in red against the nominal broad dollar index in blue. And these are roughly a mirror of each other, but there is something notable. When you see, and this very rarely happens, where the dollar's decline in value, so you know the global economy is slowing, demand for the currency is declining, and eventually crude oil comes crashing down. You see that here during the global financial crisis. But what about right now, where you're seeing not only the dollar decline in value, crude decline in value, and the CPI showing? Well, slowing? Well, it's not suggesting the dollars are losing its reserve status. It's not suggesting this thing's going to plummet to zero. What it's suggesting is we're headed to a massive global recession, because demand is actually far weaker than anyone wants to believe. And all that translates to is the Fed has gone way too far this time. And when this is all said and done, not only are they going to be back at zero, but they're going to be well below where they were before, hoping to turn this thing around. But my friends, by that time, it'll be too late. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.